is Helen Thomas and the CDFM study group. I'll be conducting the CDFM study group via the teleconference line and also on Facebook Live for those who have access to Facebook at this time. All right, so for those on the phone line who can give me feedback, how's everyone doing today? Y'all know I need, there you go, I need interaction. How's your studying been going? Would anyone like to share how the process has been going? We're all the way to Module 3, Competency 3 today. So we've gone through 1 and 2. So how's your studying process been going for Module 3? Anyone would like to share?
Pretty good, just reviewing everything.
Okay. Do you have a systematic process, certain time of day, certain time of the week? Because all of that plays a role in the studying process. So what are your the tools that you use?
Usually on Sundays, just listening to the Wednesday class and then just reviewing everything. Keep it fresh in my mind.
Right, and that's key. Would anyone else like to share before I cut you off? All right, so the key with this material is you can't just come to the Wednesday session, listen to me skip over some of the material, and then expect to understand the CDFM. It is not like going to a military school where it's like, okay, somebody's gonna give you some hints on things to study. With this information, it's a certification for professionalism. So no different than a certified public accountant have to take their exam. It's that important for you to review the material so that you can understand it. And only how you're going to do that is repetition. Because typically we do things differently than what the book says we're supposed to be doing, what the SOP says. So when you study the CDFM, you have to continuously, once you set a date when you're going to take your exams or the time frame, then you have to make a conscious effort. If not every day, a couple of hours, then maybe a couple times a week. It's best to set a schedule so that you know you can focus on that and that alone at that period. All right, does anyone have any question of me from anything we've covered in the past couple of weeks with CDFM Module 3? We did fiscal law, and last week we went over the finance portion, which is mainly the documents and entitling and payments and so forth. Any question before we begin with the accounting piece of it? Okay, I don't hear any question. And if you're on the Facebook Live, feel free to type your questions in. I may not be able to respond to the questions right then, but what I typically do is go back and review, and then I will answer the questions later after we get off of the sessions. All right, so we're on to CDFM Module 3, excuse me, Competency 3, Accounting. Who can tell me what entity at the DOD level is responsible for the accounting function? That should be an easy one for everybody. Y'all said DFAS? Is that what I'm hearing on the phone line? I think you said DFAS. DFAS. All right, y'all know I got to get feedback. You got to talk to me, right? It's a study session. I don't want you to look at it. I'm not no big instructor where I'm a subject matter expert. I'm a subject matter expert at studying the CDFM. Let me put it that way. That's my title. All right. So on page 335, we go ahead and start the introduction of the accounting piece. The first thing you need to identify from that slide is that there are 3 accounting systems. There are 3 frameworks for the accounting system, and that you're going to need to know. You have budgetary accounting, proprietary accounting and managerial accounting, managerial cost accounting. What I want you to do next to the word proprietary accounting, you need to write the word financial accounting, because those two are the same. Does everyone understand? So proprietary and financial is the same thing, but it's not in the book, so don't look for it there. What happens is you're going to see later it might say financial accounting. You're like, okay, that was not covered. So understand that financial accounting and proprietary accounting is the same. So you have budgetary, proprietary / financial accounting, and managerial cost accounting. So those are the three entities that we're going to talk about today. All right, on page 6, I need someone to read that slide for me at the top of the page. Anyone? All right, it says the United States Constitution. No money shall be drawn from the Treasury but in consequence of appropriations made by law, and a regular statement and account of receipts and expenditures of all public money shall be published from time to time. All right, what part of the Constitution talks about this that we've already discussed in previous weeks?
Article 1, Section 9.
Article 1, Section 9. Again, if you don't take nothing away from the CDFM, you need to know the reason the government shuts down is if this does not happen. You cannot take any money out of the Treasury unless you have an appropriation law or a CR, which is a temporary appropriation law. And the second part there tells you that according to the Constitution, you must also have accounting. You must also do accounting for the resources to show what you're spending, how you're spending, and what you're spending on. So that's how you interpret page 6. I like diagrams because it's easier to remember. So on page 7, you can see that there are 3 different federal financial statements. It's going to be important for you to know the differences as we move forward. You have the balance sheet, the statement of net costs, and the statement of change in net position. Again, 3 financial statements: balance sheet, statement of net costs, statement of change in net position. You see they give you examples on page 8, 9, and 10. You can review that on your own. We're not going to go through it. On page 11, I'm just kind of gloss through some of it, and some information I'll focus on. Page 11 and 12 gives you the accounting related laws that are out there, such as the budget and accounting. So again, just because I'm skipping does not mean that you're going to skip it. The only reason I'm skipping it is because the information is direct and it's complete as it is. This doesn't require any other explanation than the 1921 Budget and Accounting Act established the GAO. What does GAO stand for? All right. For those that are typing, yes, I'm paying attention now. I saw your DFAS. So what does GAO stand for? Because it's going to come up quite extensively in this section. What does GAO stand for?
Government Accountability Office.
The Government Accountability Office. That's correct. Thank you. Who does GAO work for? What is that office? Who does that office work for? What do they do?
Congress.
They work directly for Congress. What do they do for Congress? You committed now. You got to stay with me. What do they do for Congress?
That was a hard one, ma'am.
Okay, so, all right. So the GAO, we said Government Accountability Office. They work directly for Congress. and they provide the auditing functions. They're the overseers. Remember again, and I consistently go over this in every module because, as remember, the information overlaps between the modules, so you cannot take them individually by themselves. The GAO is an independent auditing agency that works directly for Congress to audit the executive branch. They audit the budget. The budget comes from the president to the Congress. Congress okays it. President signs it. It becomes law. The budget goes back to the president or the executive branch. So the GAO evaluates the executive branch to make sure that we are following the guidelines established by Congress. So on page 3313, they give you some of the, and I think we've gone over all of them except the last one. So we went over Office of Management and Budget. OMB works for whom? Some things you just got to know. Their president or the executive branch. The GAO, we just talked about, is an agent of Congress. The GAO audits the financial performance of the executive branch. That is a true statement. It may also say the GAO audits the president's budget, the PresBud. That is also correct. The president and the executive branch is the same entity. So no matter how they use the word, the interchange the words. So it says watchdog for Congress. We talked about the Department of Treasury. That's our nation's bank, the federal bank. The Treasury does not issue Treasury warrants until we have an appropriation law in place. If we don't have an appropriation law, the government shuts down because the account shuts down. We've got no money. So the fourth entity we haven't talked about is the Federal Accounting Standards Advisory Board. So it wasn't established until 1990 by the Comptroller General. Who does the Comptroller General work for? What organization?
The head of the GAO.
Correct. The Comptroller General is the head of the GAO. So it says it was established in 1990 by the Comptroller General or the GAO. The Secretary of the Treasury makes sense because they're the ones that actually move the money in, out, pay bills, and the Director of OMB. OMB is the one that takes care of the president's budget. So it makes sense that all three of those entities establish that advisory board. It is responsible for codifying the generally accepted accounting principle. So kind of the basic accounting standards for operation. They give you several boards on page 14 that you can review. And on page 15, you can see it's a repetitive information, right? Because you have OMB again with the accounting and OMB Circular 136. You have the GAO, which give you the generally accepted, I'm on page 15, generally accepted government auditing standards, and the Department of the Treasury, which give you the basic functions of operation. So the next few pages, I'm not going to go over the specifics on page 16, 17. You get the breakdown on page 18 and 19, those charts. We're going to move on to page 20. The federal generally accepted accounting principles hierarchy is listed here. Federal Accounting Advisory Board, statements and interpretation. That's again more information. So all I'm doing is showing you as you go through, you're looking for pertinent information. What really sticks out? A lot of this is a lot of data that you just have to read through. And so I'll leave that up to you. Let's move to page 3323 when we start talking about the DOD level. In the past, we've talked about the FMR, right? We always say FMR, volume 5, chapter whatever. In this particular CDFM, the only one they focus on is listed under the paragraph DOD Financial Management Policy, which is the DOD 7000.14R. And I remember saying this in Module 2 and in Module 1. Make sure you know it's point 14R. Even if you don't remember the volumes, you need to know which regulation. Because if you see it again, and it says 7000.12R, 13R, 14R, 15R, you will know you've only gone over one of them, which is 14. Any questions so far? As I drink some water. All right, I hear no questions, so let's move on to the types of government funds on page 3324. Again, we're using the 2020 study guide. So in the Department of Defense, so types of government funds in the DOD, we have appropriated funds. That's O&M, MILPERS, all the ones we've talked about primarily. Reimbursable funds, which I'm just learning about at my job, reimbursables. That means you use your funds to pay for action and someone reimburses you for it. Revolving fund. Have we talked about revolving funds before? And if so, what did we say? Anyone remember?
I think it's a working capital fund, revolving funds, ma'am.
That is correct. The working capital fund, which is an X fund. So if you hear X funds, working capital funds, or revolving funds, those all three are the same thing. So I'm going to put X fund and working capital fund next to revolving. And revolving again means the commissary takes their money. Initially, when the commissary set up, Congress gives them money, appropriate money. They take their money, they buy the food item, they put it on the shelf. Based on how much it costs them to put it on the shelf, they charge the customer a certain price. The big thing with revolving funds, working capital funds, X fund is their goal is to break even. It's not to make a profit. So they have to adjust their prices each year, unlike the commercial sector. We have trust funds. These funds are held in trust for use in carrying out specific purposes and programs in accordance with trust agreements. They give you some examples. I always like examples because it makes it easier to understand what a trust fund is your retirement, your foreign military sales, right? When they take out money towards your retirement, if you're a DA civilian, that is a trust fund. NAV funds, non-appropriated funds, right? Most installations have a NAV funds that has to be already approved for them to appropriate or to accept those funds on the installation. Not appropriate. I don't want to mix the words, because in NAV funds, it's like they charge you to go bowling on the installation. They're making money that way in the bowling alley. Fishing, wildlife, hunting. Those are not appropriated funds. Most of those are non-appropriated funds or NAF funds. Appropriations on page 25 also have categories. So I'm not going over nothing new yet. I don't remember seeing nothing new that we have never talked before. You already know that you have annual appropriations. What are the two annual appropriations we deal with?
MILPERS and O&M.
MILPERS and O&M. What about the multi-year appropriations we've talked about? I'll give you the first.
RDT&E, procurement, and MILCON.
RDT&E, procurement, and MILCON. And procurement, you also got to add shipbuilding, conversion, Navy. That is a procurement fund, but it is a 5-year appropriation. But they're still multi-year. So we've already talked about all these categories to include no-year appropriations. Permanent, indefinite appropriations. And let's see what it says in the paragraph on the bottom of page 325. It says, our funds covered by basic laws that allow the Secretary of the Treasury to pay without further enactment by Congress. Examples, we got to pay our interest on our debt. Federal retirement, Social Security, those are all permanent appropriations. So that means they don't have to go back to Congress each year. These things aggravate me. Each year to get approval. On page.
Can I ask you a question?
Sure, go ahead.
Well, regarding the permanent appropriation, does that mean that the mandatory spending that we cover about 70%, is that all permanent?
Right, so these are all the, what they call it, must fund. That's the word I'm looking at. So these are all your must funds, right? So judgment fund, like if there's a charge against the government, you got to pay a fine, a penalty, interest on our debt. We have to pay our debt, then we got to pay the interest. So if you're part of that miscellaneous pay process and you paying a bill late knowing that it's going to be charged interest, that's where all the interest and so forth comes into play. So permanent, so these are, you could say, permanent budget authority to pay those items. And then it carries over on page 26, 27. 26 again tells you the life cycle of the appropriations. MILPERS and O&M, we said, were annual, 1 year. Expense type. RDT&E are 2-year appropriations. Procurement, 3. Another procurement, which is shipbuilding and conversion Navy, which I just mentioned, is a 5-year, and military construction or 5-year appropriations. Check on learning. Can I use another appropriation to do a construction project? And if so, what am I limited to?
You can use O&M funds up to $2 million, the minor construction.
That is correct. Yes, you can use O&M funds. You're limited to $2 million for minor constructions. So if you notice what I'm doing, you don't only learn what's exactly on that page in front of you. You also want to focus on what have you already learned about that topic. On the floor of funds, we've gone over commitments, administrative reservation of funds. I have $20 to go to lunch. I'm going to put the $20 in my pocket for lunch today. I've committed the funds. Administrative reservation. Obligations. I have now bind the government to pay for the bill, whether it's through a contract or through acceptance of the goods or services, where we do it backwards. We get the stuff first and then we go back and, oh, we need to pay these folks. We do that sometimes. So obligation is legally binding the government. I took my $20 out my pocket. I went out to lunch and, let me see. And I actually ordered the food and I ate the food. I get the ticket, which is my contract. Outlays. If you notice, they didn't use the word disbursement. In the CDFM, for those that are new, outlays is the term you will use. When the funds are removed from the treasury to pay the bill, the formal term is outlay. All right, let's look on page 327. Let's see. Where it says, because I think for this part, you have contracts and MIPERS, right? Military interdepartmental requests. On the MIPERS, make sure you know that there are project orders and Economy Act orders, because you're going to have to know the difference. If not in this module, I think I saw it again in module 2. They're starting to overlap. And what you need to understand, like the Economy Act order, at the end of the fiscal year, you typically will deobligate the funds versus a project. And a project, if you listen to the word project, it sounds like something that's going to take longer than a fiscal year to do versus an Economy Act order. So you're going to know the difference between a project order MIPER and an Economy Act order MIPER. All right. accounting on page 328. All right, this is your meat and potatoes, or this is the main course of this section, is the federal accounting structure. Because if you don't deal with accounting, most of us don't, then this is something new. Let me hold on one second. Any question? I see TikTok. All right, so that chart at the bottom of page 28. I wanted to pause to make sure that everybody's online. On the bottom of page 28, you're going to have to know it. The reason I say you're going to have to know it because there are some formulas to calculate the balance sheet, the statement of net cost that you may be required to calculate. The formulas will not be given to you. You will have to know if they give you a series of numbers and it starts with a 1, 2, all the way to 8, you need to know what type of funding it is. So let's walk through it. All right, the table at the bottom of page 28 says account type 1000 refers to something that's an asset, which often has a debit balance. 2000 numbers, I mean it's a number that starts with a 2, are your liabilities, which often has a credit balance. 3000 is your net position, credit balance. 4000, or a number that starts with 4, is a budgetary, which can either be a debit or a credit. So this is not going to be as in depth as your college accounting, but you're still going to have to understand the concept of a debit and a credit. So my goal is to clarify that for you. 5,000 revenues and financing sources, credit balance. 6,000 expenses, debit. 7,000 gains and losses, both. And 8,000, which is memorandum or your other category. So your numbers run from 1,000 to 8,000. So what you need to look at before you even move on is on this chart, how many debits you have. You have assets and expenses have a debit. So I write that to the side. My debits are assets and expenses. My credit is, so I'm writing it down because I didn't have it written, so I'm going to write it down. My credit balances are liabilities, net position, and revenues and financing sources. Revenues. My both are budgetary and gains and losses. So everything you need to know about the accounting accounts, the chart of accounts, can be learned from this chart. So my debits are my assets and expenses, credit, liabilities, net position, revenues and financing sources. My both can be either or, is budgetary and gains and losses. All right, let's move on to our first. All right, so we said there were 3 types of accounting. What were the 3 types of accounting?
Budgetary, proprietary, and managerial.
Budgetary, proprietary or financial accounting, and managerial cost accounting. So your first accounting is on page 29. Budgetary accounting. So how does the numbers on page 28 come into play? If you look on the chart in the top left and right, you will see that all those numbers start with a 4. The formula for budgetary accounting: resources equal status of resources. It's going to be balanced. So long as you know if the number starts with a 4, it's a budgetary. And then if you go back to the chart on the bottom of 28, you'll see all your 4,000 numbers refer to some type of budgetary transaction. So you will know that those are the numbers you need to use. So the formula for budgetary accounting is resources equals status of resources. Your debit must always equal your credit. Let's keep that in mind. So on the bottom of 29, what they're telling you that we're going to be looking at in the next couple of pages is what type of accounting transaction or budgetary transaction occurs once the appropriation has been apportioned, allotted, committed, obligated, expired, and canceled. On page 30 is the second type of accounting, which is proprietary accounting. And you see you have two formulas there. On the balance sheet, the formula for the balance sheet is assets equal liability plus net position. The good thing about learning the chart on page 28, I'm going to keep referring back to that chart. If you notice, assets is your 1,000 numbers equal your 2,000 numbers plus your 3,000 numbers. So everything is already in order for you. Do y'all see that? Let me make sure. I see it in my head. I got to make sure you're getting what I'm saying. For the balance sheet, the first three accounts make up the balance sheet. The first one equals liabilities and net position. Does everyone see that? Was that a yes?
Yes.
Okay. And what I'm trying to, hold on, I gotta drink some water. So what I'm trying to do here is for you to be able to remember the formulas when there's no book in front of you, is knowing that the balance sheet is assets equal liability plus net position. The other formula is the second statement, because remember you have a balance sheet, you have a statement of net costs, and you don't typically have to do anything for the statement of net position. So the only two you're going to have to actually calculate for proprietary is balance sheet and statement of net costs. Expenses minus exchange revenue equals net cost of operation. That's your 6,000 number minus your 5,000 numbers equals net cost. Expenses minus revenue equal net cost. That's your third formula. So those are the three that you're going to have to know. Any question on the formulas and how best to remember them? So budgetary accounting is only dealing with the numbers that start with the 4. Proprietary accounting, you got to do the balance sheet and the statement of net cost. So how you might see it again is they just give you a bunch of numbers. They all can start with 1 all the way to 8. And then they might say, okay, calculate the balance sheet. So you have to know that you need to pull all the numbers that start with 1 equals all the numbers that start with 2 plus all the numbers that start with 3. Statement of, let's say they tell you to calculate the statement of net cost. Expenses minus revenue equal net cost. So everything that starts with 6,000 minus your 5,000 numbers equal net cost. All right, so any question on that portion before we move on now to how budgetary and proprietary accounting works into the fund flow? All right, on page 31 and 32. So let's start on page 31 to 33 actually. All right, so when Congress appropriates the funds, that's transaction number 1. They're telling you that you have two types of transaction. You have a budgetary transaction, which is a debit to other appropriation realized, and a credit to unapportioned authority. So whatever you do with one number on the debit side, that same number have to be reflected on the credit side. And I'm not trying to insult anyone's intelligence, but if you're like me, you haven't done accounting in a while, you might need some little understanding of that. So basically, you don't have to remember the 4119, the 4450. Understand it's a budgetary entry, so the numbers under it is going to have to start with 4. And that transaction number 1, once Congress appropriates the funds, you have both a budgetary transaction and a proprietary transaction. 1 and 2. Once OMB begins the apportionment process, the organizations submit the SF-132 within 10 days of the Appropriation Act, and then OMB has 30 days to issue the apportionment. Once the apportionment has been issued, then you have a budgetary transaction only. So what are you doing? Looking for differences in the transaction. So that only requires one transaction, one entry. Transaction number 3. Once DOD issues allotment, remember the fund flow, DOD issues and the agencies issues allotment, that only requires a budgetary entry. Transaction number 4, once we receive our allotment, then we begin to commit the funds. Administrative reservations, setting the funds aside, force. The budget, it requires a budgetary entry only. We haven't obligated anything yet, so it only requires a budgetary entry. Moving on to page 32, transaction number 5. Now we have a contract, obligation of funds, a purchase order, a MIPR, whatever. We obligated the funds. Once you obligate the funds, it only requires a budgetary entry. The differences come now once you receive the items that you ordered. You receive the items ordered. Whatever you order, once you receive them, it requires several entries. One budgetary entry, and then it requires 3 proprietary entries. Because you're looking at the specifics, then you're reducing your unexpended. You can look at the categories, but all I look at is transaction 6. Once I receive the items, it requires 1 budgetary and 3 proprietary entries. And once you pay the invoice on page 33, it requires both a budgetary entry and a proprietary entry. Any question on what happens during the fund flow after Congress appropriate the funds and what type of accounting transaction is required? Okay, I don't hear anything. So make sure you review the examples given. You got the general ledger on page 34, a trial balance on page 35, example of a balance sheet at the top. The end result, again, your assets must equal to your liability plus your net position. And your statement of budgetary resources. Budgetary, again, tells you the numbers always start with 4, but it still is the same. The top portion, the debit side, must equal the credit side. All right. Let's move on to 3337. Who can tell me what happens to the funds once an appropriation is canceled? We're closing out FY17, and at the end of September, come 1 October, what's going to happen to those funds that are left in FY17? Would anyone like to take that?
It goes back to Treasury and miscellaneous.
Okay, that's correct. The funds are returned to the Treasury. That's why we're diligently reducing ULOs on liquidated obligations. We're trying to make sure that things get zeroed out so we can access the funds at this point. If we wait until 1 October, we can no longer impact FY17 contracts to make payments. Those funds will be returned to the Treasury. So what they're giving you on page 37 are some asset accounts, fund balance with the Treasury. They give you the definition of the amount that's actually in the Treasury. Undistributed disbursements, Empress Fund, accounts receivable, and advances. So I'm not going to go through each one of those. They touch a little bit on page 38 on fixed assets. That's your property, plant, PPE. And what it says is general PPE, and I'm pointing this out because people usually skip it, are tangible assets, including, and then it gives you the criteria of what's considered a tangible asset. They have an estimated life of 2 or more years, are not intended for sale in ordinary operations, are acquired or constructed with the intention of being available to use by the entity. And it has an initial acquisition cost and price that equals or exceeds DOD's threshold. So we're going to look at managerial cost accounting when it starts talking about acquisition costs. Okay, the rest is information for you. So we already talked about 40, 41. We went over the balance sheet, the statement of net cost. And if you noted, they mentioned the statement of change in net position, but it doesn't require you to do anything. If you look on change in net position, page 3344, you will see an example of a statement of change in net position. All it's really doing is showing you from from 2019 and 2018 what the differences were in those accounts. So that's what the statement of change in net position is all about. So it doesn't require you to do any additional calculations. All right, so the third type of accounting is on page 46. Is managerial cost accounting. The third accounting system is managerial cost accounting. It is expected a series of accounts will be dedicated to specific accounting. So we're going to look at what type of things a manager needs to do in the accounting arena. Managerial cost reporting requirement at the bottom of page 46. They have to include direct costs, indirect costs, overhead, admin costs, all of those categories of costs that's associated with completing a mission. Formulas on the top of 47. You're going to have to know how to calculate the current ratio versus a quick ratio. And you see the formulas are pretty much the same, plus or minus the inventory. So if you have a total for cash, a total for accounts receivable, a total for inventory, a total for current liabilities, and they say utilizing the quick ratio, what is the percentage? Then you understand the formula for the quick ratio does not include the inventory total. So what I'm saying here is ensure that you read the question. You're going to get more information than what you need to answer the question. So ratio, current ratio is cash plus accounts receivable plus inventory divided by what you owe, which is your current liability. Your quick ratio is cash plus accounts receivable divided by current liability. What you also want to know is the reason. Why would I use a current ratio versus a quick ratio? Anyone wants to take a stab at it? What is the current ratio? What does it tell you? All right, current ratio tells you, and it's in the paragraph on the bottom of 47, it lets you know a person's ability to pay their bills. If your ratio is 0, if it's less than 0, then they probably will not be able to pay whatever you whatever bills they have. It is a measure of liquidity. So current ratio. So the DOD's goal, that last sentence on the second to last paragraph, the DOD's goal for current ratio is 2 to 1 or better. You want to make sure when you borrow money, you can pay it back. DOD's goal is 2 to 1. Quick ratios on page 48. The purpose of the quick ratio, what it does, it measures solvency. You compare your cash age accounts, commonly referred to as quick assets. The total of the quick assets when divided by current liability gives the ratio of quick assets to current liability. That is also called the acid test ratio. So quick ratio and acid test ratio, the same thing. All right. So that's all I'm going to say about quick ratio and current ratio. Okay, I typically do not go over the exercises, but I want to point out on page 49, when I talk about making sure you learn the chart on the bottom of 38, those accounts, is because if all you're given are account numbers, such as on page 49, you should be able to say, first column A says, is it a budgetary or proprietary action? All right, who can tell me the first one? What type of action is it? Budgetary or proprietary? That's column A we're doing. If it starts with a 4, what is it?
Budgetary.
Budgetary. So even if you don't know what 4119 means, because you don't have to know it, is budgetary. So all you have to do, you look at, once you know that budgetary starts with 4 and anything else is proprietary, then column A, all you do is you look down from 1 to 13 and you see that you only have one other number that starts with a 4, so everything else is proprietary. Now, your knowledge of the chart on page 38 again will help you with column B. Note if the account is an asset, liability, or net position. They are already in order for you. 1,000 numbers, 2,000 numbers, 3,000 numbers. And so, when you look down the numbers, you'll be able to go down and see, okay, like the first one, is it an asset, liability? Nope. Number 2, what type of account is that one? Number 2, 2590.
Liability.
It's a liability. All right, anybody want to do number 4? Number 4 starts with a 2, so it's also a liability. What about number 5? Starts with a 3. What type of account is that?
Net position.
Net position. Don't make it hard. It's real simple based on that chart. Now, again, you're given more information than you may need to answer the question. What am I talking about? In column B, number 6 is 5,900 an asset, liability, or net position. What type of account is 5,900?
An expense.
Is it an expense? Or am I thinking of revenue? Right, so, hold on. I keep saying 38. Why nobody correct me? It's not 38. It's 28. All right. So try again. Number 5. It starts with a 5. What type of account is it? It's page 28. I'm sorry, the bottom of 28. Okay.
Revenue?
It's a revenue. So if your ask is 5,900 an asset, liability, or net position, then your answer should be no. So don't let them trick you to picking one of the 3 when you know it doesn't start with a 1, a 2, or a 3, so it cannot be an asset, a liability, or a net position. So I noticed they didn't give you an option to say NA or no or whatever, but don't put anything in there if it doesn't answer the question. The same thing with number 7, number 8, number 9, number 12, number 11, because that starts with a 4. So if you're answering column B, it is not one of the 3. And then column C is asking what type of normal balance does each one have. And so that refers you again back to page 28 for you to be able to answer. Your both was budgetary and what? See, I have to learn my chart again. Budgetary and gains and losses. Your credit was liability, net position, and revenue. And your debits was assets and expenses. So if you learn the chart on page 28, you should be able to answer any one of the questions on exercise 331. And then 332 is just going over it asks you what type of entry do you need as you go through the appropriation process. Once Congress appropriates and the Treasury issues the Treasury warrant, it requires a proprietary and budgetary entry. OMB issues the SF 132 apportionment, budgetary entry, and so forth. So I think that's it. All right, so what question you have of the accounting? That's as deep as your accounting lesson will go for the CDFM. Let me see any question. Any question on accounting? All right. If not, we will go over the auditing section next week and probably start with review number 1 because the auditing shouldn't take that long. And then the following week we'll wrap up with the review. All right. If there are no other questions, that's all I have for today. This is Helen Thomas on the CDFM study group. I thank you all for stopping by, and I see you all next week as we go over CDFM Module 3 Competency 4, the auditing section of Module 3. Y'all have a great day.